Good afternoon, everybody. Welcome to our virtual investment briefing for 2020. Obviously, we'd love to be here in your respective cities presenting to you. Clearly, that's not something that's viable in the current environment. We hope that every one of you is staying safe, healthy, and also following the guidance from your respective states, premiers and governments in order for us to contain this virus successfully, and for us to be able to, restart the economy, and hopefully all the underlying investments that you have scattered across all your different client portfolios to be able to perform in line with what the expectation is going forward. So my name is Jonathan Wu. I'm one of the executive directors as well as the chief investment specialist here at Prem China Funds Management. And today we have our full complement of our investment team available to talk through the current situation out of Asia. And we have both Frank Tsui, who's a senior fund manager, as well as Gordon Ip, who is our Chief Investment Officer for the fixed income team, to present on the current themes in that area. Our standard disclaimer, and then followed by a number of items of housekeeping I'd like to start off with. So firstly, this webinar session is being recorded today. So for those of you that have colleagues that couldn't make the live version this morning, it will be made available to you via a link afterwards. Today's session has been accredited by the FPA for CPD points, 1.5 of them in total. 2 requirements for you to be able to get those CPD points. It is something that is ultimately outside of our control. First of all, you need to be within the webinar for at least 80% of the total duration. All that data is currently being collected in terms of the level of being active, which means that it's sitting in front of your screens. And then afterwards, for those here on the live session today, you'll receive a feedback form. And so once you fill in that feedback form, that will trigger us to calculate the active minutes. And then if you are at least 80%, then we will automatically issue you out your CPD certificate via email. So thank you for following those instructions. So I'm going to start off with a corporate update, then I'll hand over to Frank to talk about equity, then over to Gordon for fixed income, and then finally I'm going to sort of switch hats to put on the advisor hat. So for those of you that know my background, I've been in the advice industry for 20 years and being an advisor myself for the last 12. So I do chair our investment committee here on our advice side, as well as on our dealer group side. I am part of the investment subcommittee. So many of the considerations that advisors are taking in terms of what the current environment envisages and what sort of the considerations that you might need to take going forward in the following months and years in terms of how to construct portfolios might be markedly different. And we're going to talk through a couple of those themes, both from an equity standpoint as well as a fixed income standpoint, to give you as much context as possible in terms of what we're thinking as well from an advisor standpoint. So jumping into the corporate update, so Value Partners, our partners in Hong Kong, managing just shy of $12 billion US. They are a temple of value investing. It's something that we are very clear on, is that yes, we are a value investor, but we are a relative value investor, and both Frank and Gordon will sort of talk through how that works in reality. And then when I do put on the advisor's hat on, I'm also going to show you what Morningstar Direct sort of spits out in terms of what our style actually translates to when the portfolio has been constructed. And it is not deep value, which is something that a lot of people have sort of necessarily put us in that sort of basket. We have one of the largest teams in Asia, being over 70 team members across Greater China and Asia. We have won over 200 awards. We are headquartered in Hong Kong. We're a listed company and the only listed asset manager in Hong Kong. We have satellite offices in the mainland of China, being Shanghai, Shenzhen, Kuala Lumpur, Singapore, across Asia, as well as a London office as well, covering multiple markets. Our depth of research is quite expansive. we cover a wide range from equities, fixed income alternatives, multi-asset, as well as the quant team, which covers off the gold ETF. One of the key reasons why I put this chart up here is while the products that we offer here in Australia are covering off on equities as well as fixed income, the reality is that all the other sectors do feed in as inputs. Okay, because whether or not we are acquiring big data from the quant teams or some of the private equity or private real estate investments we have in the alternative space, they all provide inputs to then feed into investment decisions for both the fixed income and the equities teams. And so the depth of research we have in the region and what's been built up over the last 27 years is something that is something we're very, very proud of. But furthermore, it is very, very hard to actually rebuild that for any team just wanting to step in and invest into Asia going forward. So we do hazard people and investors and advisors when you are engaging with managers which have allocations into Asia. It is a very, very different dynamic to invest there and research there compared to developed markets. This is our most senior investment team, led by our two co-chief investment officers, Chia Cheng Hai and Louis So. Renee Hung is the senior investment director alongside Norman Ho. Renee is the day-to-day portfolio manager for the Premium China Fund as well as the Premium Asia Fund. Michelle Yu, if you go further, glance your eyes further a bit lower, runs our Real Estate Securities Fund. Frank Tsui, further down the list in the Senior Fund Manager list, will speak to you today. Doris Ho, who's further up the list, she is a Senior Fund Manager and is also the 2IC to Renee Hung, running the Asia and China Fund portfolios. Finally, you see in the fixed income side, Gordon Ip, who's the Chief Investment Officer of Fixed Income, will speak to you today as well. And he is the day-to-day fund manager for our Premium Asia Income Fund, with his 2IC being Elaine Hu, which is further down the list there as well. Our investment philosophy, as I said, we are value. We prefer to have contrarian ideas, non-consensus ideas, and we try to hunt for those 3 R's, being the right business, right people, and right price. The way that we manage our risk management is ultimately vis-a-vis stock selection, and that's covered off by us undertaking over 6,500 company visits a year, which is the critical input in terms of our investment process. One of the things that we've enhanced our process over the last sort of 2 to 3 years, which has then translated to upgrades for our local research ratings here in Australia and New Zealand, is that we have formed this group called High Conviction Idea Pools. It's headed by a senior fund manager or above, and they effectively split into geographical sectors, or they split into the underlying GIC sectors within the Greater China or Asia region. And each of these pools are in charge of effectively bringing forward the best of breed ideas. And it's usually each sector brings up, or each high conviction pool brings up about 5 ideas to the forefront, of which then the underlying PMs during their bi-weekly meetings receive those sort of ideas through a very structured process, and at least half their FUM of each fund needs to be coming from these high conviction idea pools. So Renee and Doris, being the fund managers for the Premium Asia Fund and Premium China Fund, they are drawing from these ideas, and over 50%, and right now it's about 60% of the portfolios come or stem from these high conviction pools. So I'll also give you an update here about ESG. So our commitment to ESG is very important, and it's something that's obviously evolving over time. And in July 2019, we have officially signed up to be part of the UNPRI, of which we then have sort of an 18-month period to be able to then deliver our final approach and strategy. And as part of that commitment, we've also hired in RepRisk, which is our screening company. So there are a number of these groups. RepRisk is based out of Europe, and effectively they provide an overlay into the order management system where fund managers, when submitting through their trades, potentially these trades can be flagged as risky. by the system, which then reports back to the fund manager in question, and they either have to justify their position to bring forward the trade again, or they're actually going to take back their trade. This is an evolving piece of work for us, but Value Partners is very committed, as are we at Premium China, into the ESG cause, and therefore this is the sort of plan that we're rolling out, and the first time that we're also speaking about it to the advisor community here in Australia and in New Zealand. So with that, and we're going to test out our technology here, is I'm going to hand the screen and the control over to Frank Tsui. Frank's just come up on the screen there, and I'll move to unmute him in a minute. So Frank is a senior fund manager at Value Partners. He's been with the group for about 5 years. And he's been traveling around the country with me normally under normal non-COVID circumstances in the last 2 years or so. And Frank brings with him over 15 years of investment experience working in both the United States and in Hong Kong in director roles at UBS and other first-tier investment banking groups. He has a bachelor's degree from Ohio State University in the United States. And so Frank today is going to talk you through, as you can see on screen, our key investment themes, and then also spend some time breaking down the performance and also what the portfolio makeup is of both the Premium Asia Fund and Premium China Fund. So with that, I'm going to hand over control. Let's see, give to Hardy. Here we go. So Frank, you should have control over my mouse now.
Okay, good morning, Jonathan. Good morning, everyone. Thank you for sparing your time in this very unprecedented and challenging period for a lot of the investors or people around the globe. I think today I will just quickly go through what I think about the market. What are the two key areas that I think investors should look at right now, together with some of the key investment themes that is being employed in our existing strategies. So if I'm just gonna go over to the market update part, there are two things that I would just like to highlight. How do you go down? So just bear with me just to. I think overall speaking, when we're just looking at the overall COVID-19, it's very damaging, as well as it's giving a lot of diverging expectations as the COVID-19 has developed in the last couple months of time. I think first of all, if we're just, I'm trying to, load up the page here. Oh yeah, there we go. What I'm saying, the kind of the damages to different countries around the world. Definitely, I think one thing is every or most of the countries are facing economic contractions. And I think what we have been tracking since the first quarter when the outbreak happened, there has been a continuous changes in terms of the negative contributions to the GDP growth. And as of July 25th, you can actually see the divergence of the damages are getting a little bit more obvious that North Asia, such as Korea and China, in terms of the GDP table on the left, they are actually recover much faster and better than the countries in South Asia. And I think on the EPS earnings, that is actually a very similar case. That on the top, that is the chart on the right hand side. Europe market is actually suffering the most in terms of the EPS growth. And if we're looking at Asia ex-Japan market, Greater China, North Asia, they are actually doing better. I think what we're trying to look at from the COVID damages is let's not look at the absolute number right now, because it's actually deemed to be a little bit less relevant. But it's actually, investors should be looking on, the relative damages and the relative handling by different countries on the recovery. I think this is the most major focus that investors should look at. Why we're actually seeing a relative better situations in the Asia market is because the okay, just hold on. Trying to get the screen. Okay, excuse me just for a quick second. I want to show slide 15. Well, I think maybe I'll just continue with my presentation first. If we look at the overall balance sheet strength in Asia ex-Japan market, I think key very notable differences. If I'm not sure if you could look at the slides here, but I'm showing the overall balance sheet strength from a cash level perspective and also from a debt level perspective. In North Asia, including Greater China and Asia ex-Japan, versus the rest of the world, such as developed Europe, developed market in Japan and US, Greater China and also Asia ex-Japan corporates are having higher cash level and lower debt level, as it shows on the bottom of the chart. I think this is actually very kind of like crucial at this period of time, simply because when there's a crisis happening in the market, usually solvency risk is probably the key driver that will be giving a very damaging and destructive kind of problems with a lot of corporates. So because the solvency risk means whether they could be sustaining their business, running the business with sufficient cash flow. And I think overall speaking, from an EPS perspective that I have presented in the previous slide, I think why Asia actually did better is the corporate balance sheets are actually generally looking better relative to the rest of the world. And I think in China, as you could see here, I'm not showing any kind of like official government economic data. Where instead I'm actually giving the channel check data that we actually consistently monitor, especially during this COVID-19 period. Because why we're doing this is we want to track how the economic activities has been recovering, on a month-on-month basis. To a certain extent, some of the data we're tracking on a week basis. So from March, April, May to June, I think China actually do recover and can be considered as a first in, first out situations. Mobile phone sales, passenger car sales, particularly in the luxury car sales, the new home sales, which have been doing much better than expected than the previous cycles. It's actually up by 16% in May and June. And when we're also tracking on individual companies such as hotel, occupancy rate, and also some sportswear number, they're all kind of like coming back up from a contractions in March and April to positive territory and back to growth numbers in May and June. And I think a lot of people actually have been questioning or thinking whether the data coming out from the Chinese government, whether those are reliable from a PMI perspective, from a GDP perspective. And I think this is there's a lot of reasons why we're actually doing all these channel checks. We're doing on the ground research. And I think I was just also been checking with a few of my close friends. They're American, they're British, but they're based in Shanghai. Things are pretty back to normal, that you're seeing restaurants are starting to queue up, and the life that people are actually hanging out on the streets are actually getting pretty similar to the pre-COVID-19 level. So there has been a lot of cross-checking in terms of how China's recovery is doing, and based on what we know, based on these data, and based on our conversation with corporates, they have been on track on the recovery. And I think overall speaking, from a relative perspective, there are a couple of key things that a country should do just to have a much better risk containment. I think first is, when you have a new cases, then you have a very strict lockdown, and then followed by a very stringent virus tracking. And also when we're looking at, the overall the border control. I think what China has done better relatively is simply because after the lockdown, strict lockdown, they have been tracking, and people coming back to town or coming back to cities from foreign countries, or from different cities, they require a 14-day very strict isolations. So that has been something proven that actually seems to be working in terms of the risk containment. I'm not saying there won't be a second wave or third wave. It would definitely happen, because when economic activities or everything just started to reopen, the risk will be coming back. But it's just all about how the country respond accordingly, and how to contain the virus from not spreading to nationwide, or from a in a very swift kind of pace. So I think China, to a certain extent, they're still, doing okay from that perspective. And think just page down. And I think so. This is first thing. When I'm looking at the overall recovery, China, Asia, they have been doing relatively well. From a policy perspective, I think there has also been a bit of a divergence in terms of how central banks around the world are executing the policy easings. If you look at the chart here, obviously Fed, BOE, ECB, they're actually really looking, a similar way as they did back in GFC back in 2008, but at a much bigger scale. Fed in the US, they're actually doing unlimited asset purchase, despite, there will still be some, kind of like rolling out by tranches. I think this is actually a very, a strong indicator on how we're looking at the equity market or capital market in from a liquidity perspective. I think the liquidity will remain very abundant. There will still be excessive liquidity throwing into the market, just simply looking at the asset purchase program from the West. In Asia, it's slightly taking a little bit different approach. If you look at the PPOC, looking at this chart on the very right hand side, there has been zero quantitative, kind of like asset purchase program that's being implemented. Reasons being is, looking at the next slide, Asia central banks, they're actually taking fiscal deficits, and also by lowering interest rate, and also required reserve ratio, just to put liquidity back into the system. I think just looking at the fiscal deficit level, it has already approached to the GFC level at about 12.7%, whereas back in 2009, the fiscal deficit was only about 10.3%. So I think what actually has been a little bit different versus the GFC situation is government and the central banks have responded much more swiftly. And the scale is actually being much higher. I think from a policy implementation perspective, the differences between the West and the Asia market is Asia tends to have a lesser pressure on the central bank balance sheets, and I think this is also the reasons because of there are actually a little bit more room for further interest rate cut. If you're just looking at the overall interest rate environment, I've highlighted the MLF and the LPR. These are the interest rate reference in China. I think if you're just cutting 25 bips or maybe 50 bips every single time, there could still be a lot of room for further interest rate cut. However, I think what we're actually looking at is regardless of interest rate cut or quantitative easing, or from an asset purchase perspective, one thing for sure is the lower interest rate is going to be sustained for longer time, and also the asset purchase program from the West will flood the market with excessive liquidity. And I think from what we have experienced back in about 10 years ago, this is particularly favorable to risk assets. So I think from a policy perspective, that's a good conclusion on how we're looking at the capital market, going to the second half of this year. I'm just gonna get one quick slice on the Hong Kong macro environment, and I think there has been a lot of like headline news about the Hong Kong security law, and also about the sanctions to Hong Kong government officials, and also about a potential kind of like restrictions on Hong Kong market, similar to what China has faced in the last 2 years' time. One thing I would like to highlight is there has been, no doubt about, noises from a political standpoint. And what we are trying to look at is what are the actual damage, and also what are the actual, economic kind of like detractions coming from all these potential policies. One thing that I've just highlighted in this slide is, the export tariffs in Hong Kong. I think that it's actually not especially, kind of like meaningful or having a very material impact, simply because if you look at a chart here, the domestic exports to the US from Hong Kong only takes up 0.1%, because over 90% of the Hong Kong exports are re-export. So from that perspective, the tariff, doesn't really apply, because the tariff already applied to, the origin of the manufacturing, which are mainly coming from China. So from that perspective, it sounds like it's actually very punishing. However, from a, actual economic damage, it's more symbolic rather than having a material kind of like damage to Hong Kong market. I think from that perspective, I would still say this will continue to make some noise ahead of the US presidential elections by November. And I think one thing, the last thing that I would like just to highlight on the Hong Kong macro part is Hong Kong is having about actually, sorry, I'll just put it this way. US is having about 3% trade surplus on Hong Kong. So basically, US corporates in Hong Kong, they're actually having a surplus rather than deficit, similar to the case in China. So there's actually a lot of mutual kind of benefits between US and Hong Kong. And I think the benefits from the US corporates in Hong Kong are actually generally more than the corporates in China. So yeah, that's my view on the Hong Kong market. And I think just okay, maybe just the last point from a valuation and EPS perspective. North Asia is still looking more attractive, because from a PE level, the China Asia's market, Korea, Singapore, Hong Kong, China, they're being looking at the lower level relative to the other countries, as it shows on the upper chart in blue color, but also looking at the EPS growth in the orange bars in the lower chart. Korea, Asia market, Taiwan market is still looking attractive. However, I would just say PE ratio, when it's still on the kind of like overall downgrade trend, it may not be too meaningful just to look at PE ratio, but looking across different sectors that we're looking at, I think even after the rallies in the first in the last couple months of time, the valuation is not looking very stretched. We're actually looking more at a historical average level based on the high convictions that we're looking at right now. So I'm just quickly going through into the some of the key investment themes that we have been doing, not only during this period of time, but also since I think the last 12 to 18 months. I think last year when I was in Australia, I had presented similar themes, and one good thing is we haven't changed much, but obviously there has been a bit of updates during the COVID-19 on how they have been doing in this challenging period. First of all, the consumption upgrade. I think consumption upgrade, it's let's put it in a simple way, is people are generally willing to spend more money to enjoy better life and better products, and this is actually usually come with three characters in this consumption upgrade process. First is on the very left, you're actually having about some new product innovations that you could attract these people who are willing to pay up. And I think I've just looked at different consumer related sectors such as dairy, brewery, instant noodles, sportswear. What you could do from an innovation perspective in China is you could have the pasteurized yogurt, you have high-end craft beers, and you have high-end cup noodles, which claims to be a little bit more healthier than the general one. And also the fashion casual sportswear. What it does is it attracts people to buy more and pay up for the premium. And usually these products generally charge higher premium, and that gives a bit of margin expansion. But as people are willing to spend this money, you're helping the companies to get better market shares, and that's why you're actually having the market expansion. As you could, as I show it here in the middle of the table, that dairy, brewery, instant noodles, they're actually really continue to gain market shares because of all these innovation products. And lastly, it's about because of the higher volume, buying higher margin products, literally that will be contributing to the improving profitability on the tables on the very right hand side. So these names, dairy, brewery, they're actually catching up with the overseas peers, as it shows on the very right hand side of the chart. Sportswear is probably near the international level right now, but there's also the volume that will be driving the overall company's profit outlook. And what happens in COVID-19, I think these themes or this consumption upgrade is actually proven to be very sustainable and less vulnerable to the external macro environment. I've just taken two examples on the holdings that we have, which I will later kind of like cover in the fund levels. That the market price of Feitian Maotai. This is actually the top notch of the Maotai kind of like bottles. The ASP, that's the average selling price per bottle, has swiftly picked up back to the historical record high level at 2,450 RMB per bottle. That has been a very swift kind of like recovery in terms of the price of the bottle. And simply because people are just willing to pay more. And I think the sports shoes in China, the average, unfortunately, I'm not sure why it's actually showing value in first quarter 2020, but currently it's standing at about 355 average RMB per sports shoes versus about 1 year ago, which is standing at around 288, and about 2 years ago at 275. So there actually hasn't been really a big impact to this what we call the consumption upgrade items. Even when COVID-19 is actually damaging the overall retail sales market. And I think from a consumption update perspective, consumption upgrade perspective, we're actually more positive to premium Baijiu on the right, sportswear, luxury jewelry, and also cosmetic skincare versus dairy in a slightly more positive, and to the neutral, the casual wear, which is actually a little bit more difficult to have breakthrough in terms of having innovation product to make people to pay more. So these are the consumption upgrade that remains very intact. And also talking about the technology, I think we have been very closely tracking, what has happened to the technology hardware space, particularly the 5G mobile phone sales. This is the sales number globally, but when I say 5G, basically currently it's only China selling the most, while because of the network that has been facing some kind of like discussions in the US or in the West. Currently, it's still looking at around 18%. It's creeping up, from February, from low single-digit percentage to 18%, which remains very robust. And we're actually still expecting this 5G mobile phone taking up 35% in next year. I think what I've always been talking about, the 5G is it has opened up a lot of like growth avenues that 4G did not offer, including in the consumer space. We have seen more smart devices or smart vehicles that is happening, and also industrial is probably the biggest area of growth looking from the 5G technology hardware level. So this just very simple figures that 9.1 billion smart devices connected in 4G era. We're looking at about 25.2 billion devices to be connected in the 5G bandwidth. So that actually is giving a lot of growth. I think, sorry, just going back to one question that many people may ask is about the technology restrictions and also the Sino trade situations, giving a lot of pressures to Chinese technology hardware companies because they couldn't get the good supply and the advanced technology parts from the rest of the world. I think how we see it is the Sino trade will continue to put pressures, but it's also speeding up Chinese companies to manufacture and do R&Ds domestically. And also, we're not, for companies such as for strategies such as Asia ex-Japan mandates, we're also able to, look at other Asia countries such as um, um, such as what we are seeing in South Korea and Taiwan, that they are taking up more market shares from the smartphone in the Huawei situations. So in the overall level, I think the technology also, kind of like go over to the e-commerce space that we're still expecting very robust growth number, particularly after COVID-19, as people's behavior has changed from offline to online. However, we're actually looking into a more, growth, potential in the services level. That means people consuming services online. China is still lowly penetrated versus the other countries. And also when we're looking at the overall monetization rate. On the left-hand side, we're actually looking at the largest e-commerce platform that the monetization rate is only at 0.82%. That consists of mainly the consumer goods, physical goods. On the online service side, on the right-hand side, the monetization rate in China is only at 0.13%, which is still extremely low. So there has been a very obvious growth potential. I think I'm actually aware of the time with 5 minutes left. I'll just quickly go over two more things before I get into the portfolio constructions. Education is actually, something that we have been, looking at a very, I'll probably say, uncorrelated to the macro environment, because Chinese government is actually still having a very, I would say, robust and solid agenda to add more skilled workers to the populations. And I think this is part of the transitions in China to move from a lower end to a higher end value chain. So that actually has been giving a lot of, policy reform to increase the number of university graduates or vocational workers in the system. So just one simple number that I would like to highlight is the chart on the right-hand side. Currently, 48% of the people are enrolling into the higher educations, and the target is actually 65% set in 2035. Lastly is the healthcare sector. I think just two quick points to highlight is the aging populations and low medical expenditure. And because of these two factors, Chinese government actually have been really taking a lot of efforts to reform the healthcare sectors. And one key thing is the innovation drug in China that is driving the major growth in the drug market in China in the next couple of years of time, which is we're looking at 27% CAGR, which is at the red color of the upper charts. And that's why we're actually having more positions in companies that are engaging or having a very solid pipelines in the innovation drug market. So lastly, maybe I'll just quickly go through the premium Asia funds and China fund on why and what we have been doing based on what I've just mentioned. Year to date in the premium Asia fund, we're still kind of in a negative territory, but looking at 1 month, 3 months time, we are actually coming back up quite strongly when market are refocusing the investment in corporate fundamentals. What we have gone through from an investment theme perspective is we have more exposures or sticking with the consumer discretionary information technology and also consumer staples, even communication services. Those are companies that are engaging in the online communications services. These are the core holdings of our portfolios. And as we have also mentioned earlier, North Asia, including Greater China, Hong Kong, Taiwan, South Korea, and Asia's market is still being, our top exposures, simply because of they have a much more robust growth visibilities, as well as the countries is actually recovering better relative to other countries in South Asia markets. In terms of the top 10, these are the names that I have just basically gone through. Alibaba, the biggest e-commerce platform. We have Meituan, that's on the number 8. That is the largest services e-commerce platform. We do have some Baijiu's companies, that's a white liquor, benefiting from the overall consumption upgrade. And I think technology sectors, we are actually looking into South Korea and Taiwanese market, simply because of the very robust 5G beneficiary in the regions that they're being the leaders in the space. We have been looking into a little bit more of a jewelry kind of recovery. So that's why you can see we have number 9, Chow Tai Fook Jewelry Group, as they are benefiting from the reopening economy in China. So all in all, we're actually looking at a very consistent message about consumption upgrade technology and online consumption within Asia ex-Japan market. In the premium China fund, I think that actually has been a little bit more kind of like robust recovery. 1 month, 3 months, 6 months time is actually in positive territory. One key difference other than sticking with the consumption upgrade is we have less information technology names within the premium China fund. I think that's something I've mentioned earlier about the Sino-trade situations that we're seeing the supply chain being reshuffled, and I think currently we're seeing a better investment opportunity on the technology hardware companies in Taiwan and South Korea. That's why we had Samsung Electronics and respective Taiwanese hardware names in the premium Asia funds, where in China fund we have less exposure in this area. So information technology is currently looking at around 4%. However, consumption discretionary staples and communication services are still pretty much in line with the investment themes that we have. So in the top 10 holdings, names are pretty familiar, as I have just mentioned throughout. So we're sticking with some of the probably some higher education's names, which have done quite resiliently in the last 2 to 3 months time, because of their very insensitive character versus the macro environment. So I think I'm just gonna conclude my presentations here, which is on time given the 30 minutes range. I'll just pass it back to Jonathan over in Australia. Thank you very much for your time.
Thanks, Frank. I'm just going to switch it back to me for a sec. Okay, so thanks very much, Frank. That was great insights in terms of talking through the themes. As you can sort of see, the depth at which we go through our investment themes with you is at a level that is obviously much more than many other groups can, solely because of our depth of research. So something that I think a lot of you on the call do sort of appreciate also when we come to you one-on-one, where we catch up with you guys in person, which hopefully won't be too far away. Before I introduce our next speaker, Gordon Ip, I do want to sort of speak to currently the fixed income environment and sort of what the challenges you as advisors as well as researchers are facing in a near zero environment. So this is a chart that I keep updating, and it does sort of point out the challenges in picking fixed income managers. And there's sort of 3 in which it keeps being updated, but it's sort of the third one is more cognizant today sorry. Apparently you can't see my screen.
Oh.
Is my screen all good? Yeah, that's good. Okay, so in terms of the three challenges that we have, the first one is the fact that when you're in the fixed income market, the issue is that most managers are using the same piece of research as their initial screen. Okay, what we refer to here is that most groups are using S&P, Moody's, and Fitch to effectively filter what they want to invest in. So whether they be an investment grade fund or a high yield fund. Okay, so for those of you that are not so familiar with the fixed income market, investment grade is sort of, in general terms, anything that's rated BBB and above, and anything that's lower than BBB is effectively high yield, which inherently, on a very general perception, shows that there is, high levels of risk. We're going to talk through that in a minute, because in this current environment, it doesn't necessarily show that. The then fundamental problem is that in the equities world, you don't have the situation where fund managers are effectively using the first initial same screening point. It simply isn't the case. And so if you then are focusing on going higher up the credit rating level or going lower down the credit rating scale, the investing in fixed income becomes quite homogeneous in nature, okay? Which then leads to the ability to value add, or the number of levers you have to value add becomes more and more difficult. And so when we have a very low risk-free environment, this part doesn't change. And this morning there was some talk about RBA rates going even further lower, given what's happened sort of in Victoria. We might see another 15 basis points cut down to 10 basis points as our RBA rate. Term deposit rates become unattractive. And even as at now, it's already seeing a sort of 0.75% for any 6 or 12-month period. Then you couple that with the minimal spreads you see on fixed income instruments overall, which makes it even harder to justify the returns that you are actually deriving for your clients, net of advisor, fund manager, and the platform fee. And I'll talk through that in a bit more detail later. The third point, and here's sort of the proof in the pudding, is have you had a look at the performance of the fixed income managers you've used during the COVID crisis, okay? Especially during the month of March. Now, granted, most of the movements and some of the negative returns that you would have seen during March is related to the mark-to-market situation. Total withdrawal of liquidity, and Gordon's going to talk about that in a minute. But what we also saw was that some high yield managers, pure high yield managers, outperformed investment grade or hybrid funds. When I refer to hybrid funds, I mean funds that are sort of could be half investment grade, half high yield. And so it's very interesting to see that dispersion of manager performance during March. And then how does that actually end up deriving returns for your clients if they're holding these funds for the medium to longer term? So we run a multi-strategy fixed income fund, which effectively is trying to achieve two things, really simply. We're trying to derive a strong yield, okay? A yield that you can basically look your client in the eye and justify to them that I'm deriving you something better, net of all my fees, the fund manager fee, the platform fee, and my fee as an advisor, something deriving for you that's going to be better than term deposit, okay? But it doesn't generate an excessive amount of volatility. And then furthermore to that, we're trying to buy a set of bonds that is trading below par value. And the reason why we're trying to find these bonds that are trading below par value is because we're looking for some level of capital appreciation, just to give you that extra bit of kick or extra bit of alpha. And that's something that we've systematically achieved in the sort of close to 9.5 years that this strategy has been offered in Australia. And furthermore to that, our own family has invested $5 million of our own funds into this strategy. And it's been there since day one, and it's just basically chugged out the performance and the expectations that we've had, and actually sort of even exceed what we've had. So I'd like to introduce Gordon. So Gordon is the Chief Investment Officer of the fixed income team at Value Partners. He has over 20 years experience in fixed income markets, and Gordon joined Value Partners back in 2009 as a fund manager, and slowly moved up the ranks and now has become the CIO. Gordon has won numerous awards. So he was crowned 2018 the CIO of the Year for Fixed Income by Insights and Mandates in their I&M Professional Investment Awards. He was named Manager of the Year for High Yield Fixed Income by Benchmark for Fund of the Year Awards in 2018 as well as 2017. He is one of the most highly commended astute investors in Asia G3 bonds, Hong Kong, which is also awarded by the Asset Benchmark Research Awards in 2018, and also voted as one of the top 10 astute investors in the same category, being Asian High Yield for 4 consecutive years from 2014 to 2017. Gordon holds a master's degree in financial mathematics from the University of Chicago, as well as a master's degree in engineering from Cornell. He is also a CFA charter holder, so he has the experience, the academic qualifications, as well as being awarded endlessly in the last sort of 5 to 6 years. And when you look through our performance of the way he constructs portfolios, you'll certainly understand why. So with that, I'm going to hand back over to the guys in Hong Kong who talk you through the fixed income markets. Over to you, Gordon.
Hi, how are you? Good morning. Okay. Okay. Everybody see the screen? Okay. So yeah, let me just thank you for everybody's time this morning. Right now is a challenging time, so I just wish everybody stay positive and stay healthy. It's important to stay optimistic in this kind of challenging environment. So yeah, so Jonathan just gave us a very, very good introduction of our philosophy and our process. So why don't I just start with a general description of the global pandemic situation. So as one can actually learn from the news that China is probably the first country to have successfully controlled the spread of this virus, and arguably they are the first to emerge from this global pandemic situation. These are the confirmed cases that we collect from Bloomberg data. As you can see, the top chart, China, the confirmed cases has been reported to be very, very low. However, if you look at elsewhere in the world, especially the number from the US, you can see that some of these countries in the world, they are actually really not out of the wood. In fact, in particular in the US, if you pay attention, the confirmed cases are still climbing with nowhere sight where the peak is. And so therefore, there going to be a big drag on their economic activities and therefore their GDP growth. Now, in terms of the Chinese economy, Frant previously has also reported some of these numbers, but I'm just gonna repeat it a little bit. So we argue that China is the first to come out, and arguably they're the best position to stay strong, even possibly a V-shaped recovery post COVID-19. Just to collect some of these hard data from the data sources. So, for example, if you look at the industrial production in May, it was up 4.4%, following a 3.9% increase in April, and we're looking at further positive gain also in the latest set of number. Electricity output, this number cannot lie, because when we restart the economy, factories start to mix manufacturing goods and services, they have to use electricity. So this is one number that cannot lie. And in particular, if you look at the number in the southern state grid, basically it supply electricity to the manufacturing base in China, meaning the Guangdong province. You can see that the recent number also posts a very positive year-over-year change from the data source. Retail sales, obviously, on the overall basis, although it's recovering, but on net basis is slowly recovering. But as one can imagine, under the COVID-19 situation, online sales has been very, very strong. Same-store sales has been recovering steadily as people come out to eat, to shops. And even you were talking about hotels occupancy or domestic flight, We are, for example, on hotel, we are talking about we are back to about 80% pre-COVID level. And on the domestic flight, back to 60%, although international flight continue to be very, very challenging. On the more even talking about property, property and construction, we have seen a very, very strong rebound in demand in cement, in rebar, and even property sales over the past few months. So collectively speaking, all these numbers provide further proof that China economy has really restarted, and they have the stronger chance of staging a possibly V-shaped recovery in the next few months. Now, after March, as many of you know, that other rounds of interest rate cutting and quantitative asset purchase program by the global central bank. What we see today basically is kind of like a repeat of the 2008, 2009 after Lehman Brothers crisis. What we see today is an ultra low interest rate. So we believe a low to even negative yields going forward will likely to be the new normal. So in this kind of environment, one investor needs to ask, how do you generate a reasonable return, of your cash in the global market? Honestly, it's not easy. This is a chart of all the global interest rate and the bond yield expressed in US dollar term. As you can see, if you just randomly draw a line saying, okay, how much of the bond out there in the global market is giving me a 1% or below, okay? Basically, you are looking at that yellow part. If you look over to the left, you can see is right now, after March, we are talking about more than 60% of the global sort of yield product giving investor an interest rate no better than 1%. And if you look at the below zero or the sub-zero universe, it's actually gone up as well, and it's continued to climb. And if you're just basically talking about, how much of these global bonds are giving me a yield of 5% or above, you are basically looking at that a tiny corner on the upper right. That universe basically give you a interest rate or yield more than 5% or more. And we are talking about just roughly about 3% of the universe in the global market right now is giving you that kind of yield. So obviously, just by looking at these charts, although it's very, very depressing, there are ways for us to generate a reasonable yield, enough to beat inflation and also give investor a reasonable rate of return. Now, post-March, one thing we noticed is the continued rallying in the US market, both equity and fixed income. And we believe this rallying is basically driven by two factors. Number one, obviously, is the bond buying program or asset purchase program by the US Federal Reserve. In the past, the Fed only buy quality bonds, but this round they even buy high yield bond. So what essentially is that they are basically manually pressing down interest rate to help the economy, to help the company to refinance. But the downside of this Fed action is that basically, if you artificially compress all the yield and spread into such low level, the US Fed is basically taking a lot of market information out, which prevent market to properly price a lot of these risk assets, both equity and fixed income. And number two is that I think a lot of investors holds the view that they expect the U.S. economy to be a V-shaped recovery. Okay, at the end of the day, ultimately speaking, U.S. was performing quite well pre-COVID, but is this an assumption that people can really make on a post-COVID world? This is something that investors need to ask themselves. And honestly, the investor will have to make certain assumption of the Fed and the U.S. economy. Can these assumptions, the action of the U.S. Fed and also the stage of the U.S. economy, can either or both of these disappoint investor? Right? Remember, back in 2013, that was the time when the U.S. Fed announced the tapering on the interest rate and bond purchase program. I remember that time the market has experienced a dramatic sell-off just by the fact, the intention, and just that they say they intend to taper. They haven't really done it, and that already caused a big problem in the U.S. market. So what we see is that, so especially if you compare this expectation and market performance versus the situation on the pandemic, this chart basically show you the white line is the confirmed COVID cases in US. As you can see, is climbing. Okay, this chart looks really good if this is the stock market. It's conjunction with a ever rising S&P 500. Right now, the PE ratio is around 21, 22. And also a continuous rallying in the bond markets. As you can see, the 10-year yield continue to come down to right now less than 0.6%. Okay, so the combination of these three lines, basically it puzzled me and it puzzled a lot of market participants that we don't really understand why a ever rising COVID cases is accompanied by a ever rising US stock market and an ever rising bond market in this country. One reason could be that because arguably speaking, the first round of the rally was actually relatively quick. When and there's a lot of guys that they basically missed out on the first round of rally, and they felt missing out because a lot of these guys, they are compared to index performance. So when the index is outperform your portfolio, if you are a portfolio manager, you are under tremendous pressure to increase your allocation, even though you do not, or you have a slight even uncertainty of to judge that rally. So the second round of rally was basically fueled by the guy who felt that had missed out, and they're under pressure to deploy capital to work. Anyway, so the combination of these three charts that basically prompted my team to think that right now the U.S. market, both equity and fixed income, on a risk-reward basis, they are not attractive. They might as well stay at the current level or may even go up a little bit because, as I mentioned, there has been a lot of forced buying of sort of passive money in this market. And arguably speaking, for a lot of manager, U.S. market right now is the only market they can invest, because after the March sell-off, risk-off mode, people pull money from the emerging market. Right, because of the U.S.-China situation, manager has hesitation and investor has hesitation to invest in Asia and in particular China. Euro hasn't been working for a very long time, and so has Japan. So just the byproduct process of elimination, U.S. market right now is sort of the quote-unquote only market that people can put money. And therefore, what you see today is even though they're worsening pandemic situation, their stock and bond market are still rallying quite strongly. But I feel that the more it rally, the less will it rally more. So that means increasingly on an increasingly basis, the risk reward to me at least isn't attractive at all, because any thing go wrong on the Fed action as well as the hard data from the U.S. economy, anything if it's disappointing, you could invite a really dramatic sell-off in both asset classes. However, if you look over to the Asian market on a relative basis, as far as credit is concerned, we think that Asian credit offer a very decent yield spread over comparable U.S. credit. For example, on the left chart, we plot the yield spread between Asian investment grade over comparable U.S. investment grade bond. As you can see, right now it's still yielding over 120 basis points over U.S. IG. On the high yield side, we are talking about on average, on ballpark, 200 to 300 basis points over U.S. high yield. And therefore, if you look at these kind of relative valuation together with the pandemic situation in Asia, we argue that the risk reward are much more attractive than the U.S. market. In Asia, we like Chinese credit. a lot. And basically, within Chinese credit, we favor China property over other sector. We like Chinese credit right now. There's a lot of reason for us to like it because, well, first of all, it is the biggest segment in the Asian credit market. China and Hong Kong together, we are talking about over 60% of the entire universe from issuer from China and Hong Kong. And right now, arguably speaking, because of the noise in trade war, Western guys, they are not really deploying a lot of capital into Asia and in particular into Chinese related name, simply because of they think they are political risk. They don't know what the Trump administration will do to US company and all that. They have a long list of reasons to be very patient or to invest in China. So that creates a void in the market that, for someone who knows the market, there's a lot of, we can take our time to do our homework, and also there are a lot of void in the market that we can take advantage of. Within the Chinese credit universe, we like property. I have said it many times that property sector is one sector that has historically shown a higher recovery value in case companies go into a bankrupt situation. Ultimately speaking, these are the company, they have land, they have buildings, and the value of these assets are very easily verifiable using public source. So their visibility is often higher than company in the sort of industrial sector. Okay, and also in the current environment of U.S.-China trade war, property sector, as many know, it is one sector that is completely domestic in nature, meaning they don't do import-export to other countries, and therefore they are less impacted by the trade war right now. They are more driven by domestic demand. If you believe what Frank said, that the China economy has transitioned into a more consumer or domestic demand-driven economy, a holding in property sector is one way to express that view. Number two is, even though we saw a very slowdown in contract sales during the COVID period, mainly February and March, we see a strong pickup in contract sales post-COVID. And in a way, ironically speaking, the COVID-19 actually hit the China property market in a relatively good time. What I mean by that is that, historically speaking, Q1, meaning from January to March, has historically been the slowest season in terms of contract sales because of Christmas, because of New Year, and also Chinese New Year. When people go back to enjoy time with their family, they have no time to shop for property. So in a way that, from this perspective, the COVID-19 actually hit the property sector in a relatively good timing, in the sense that the season has already slowed. So there's not much they can do in terms of damaging the contract sales. Plus, if you look at across the entire universe, property developer, we look at their refinancing needs and liquidity needs in 2020. What we can clung to is that thanks to the very strong new issue market at the beginning of the year, and also the onshore funding environment, I would say right now around 75 to 80% of the money that they will need for the rest of the year has already been secured, meaning for the next 6 months to 12 months or so, a lot of these companies, their liquidity profile and also refinancing profile is actually very, very manageable. But if you look at the pricing right now, you look at the BB, the benchmark BB property name, they are right now around 5 to 6%. Actually, no, 4 to 6%. Single B, benchmark single B, you are talking about 7 to 9. And then single B flat to single B minus, those are 9 or about, and actually some of them actually in double digit. So if you convert these price into a sort of implied probability of default, we notice that the default risk in China property right now is actually quite overstated. compared to historic average. So the combination of all these factors lead us to believe that Chinese credit in general, and in particular China property credit, it provides a really good yield pickup for investor, and we believe that it is a very good risk reward for investor to consider in the current market. So in summary, right now, obviously, we are in a very uncertain time. The world is very fragile. The visibility is very low. And therefore, investors to expect volatility is probably to be here to stay. And investor needs to be cautious. And at the same time, very important that they need to be patient. The day you make quick money is behind us. Okay. However, investors should not be overly risk averse because, as I showed you in the previous slides, that there are money to be made in the market, especially for segment of the market or names that the majority of the market participant they don't bother to analyze, or they don't have the capability to look at, or they just don't want to be bothered. Those are the area that we, the Value Partner team, has spent a lot of time to research to actually make our investment. So those are the areas we believe that there could be a lot of opportunity, both for income generation as well as potential capital appreciation. So therefore, we believe that a portfolio that can provide strong income, manageable volatility, and possible potential capital appreciation can be constructed using the instrument in the market space right now. In that, we favor Asian IG and high yield, and in particular, China property, high yield property. So our strategy in the credit spectrum is basically follow a so-called sandwich strategy, in which we go down in credit curve in IG and we go longer in duration. So we like BBB to BBB minus long duration IG bond to capture the technical advantage of long duration bond in Asia. However, on the high yield, we are actually more defensive. So in the high yield area, we tend to do more up in quality trade, meaning doing more single double B benchmark name, mostly B plus to B benchmark name, and selectively on B minus. Basically, those are the names that are less researched, less followed, and being less played by the majority of the market participants. Okay. So let me just take this time to go through quickly the fund performance as of the end of July. So even after the March sell-off, I'm very happy to look at this performance chart. I'm very happy to see that it's still by and large maintain a straight line, since inception of the fund. March is, on a grand broader sense, March is a blip of the market. So our long-term performance continues to be quite satisfactory. Over the life of the fund, we have returned a 9.6% per year to investor, with a much lower realized volatility of 5.8%. As of the end of June, the yield of the portfolio is around 11%. Cash yield, that means the coupon, the accumulated coupon of the portfolio divided by the fund NAV, was around 6.7%, and that's enough to pay the sort of around 6% annual dividend to our investor without deducting from the fund's capital. Duration, we are at 3.7 years, mainly because, as I mentioned, we have long duration IG bond coupled with a short duration high yield bond. And the years to mature is 5 years, and we have only held less than 60 positions in the portfolio. Arguably speaking, those are the high conviction idea from the research team at Value Partners. In terms of our various exposure, Hong Kong, China continue to be a high concentration right now at around 76%. I mentioned earlier that Hong Kong, China alone, just in the universe, was over 60%. So you can think of we are right now overweighting around 10 to 15% on Hong Kong, China market. Japan, we have 8%. Those are investment grade bond. We just added it more recently post COVID-19. We have some Japanese pharmaceutical company long duration bond that we can take advantage of both the interest rate rallying, yield curve rallying, as well as it could have the potential of benefit from the having a test instrument or drug that are related to COVID-19. Indonesia, we have some energy company and also some real estate. And Macau, as many knows, those are all mostly casino company. On the hedges, we make good money because we have increased our Aussie dollar hedge all the way from 58 cents to the dollar. But by the time we settled the contract, it was at 68 cents on the dollar. So the hedges has both made us good money as well. On the sector-wise, no doubt to say, we continue to like real estate as 41%, but we also have good representation from other sector as well. I mentioned that we like high yield, we like single B and below, and also double B. So therefore, you will see a huge allocation to that area. And just to repeat, those are the high conviction area. Those are mostly the name that not many guys look at in the market, and therefore, if we like, we can buy a lot at very, very good prices. And that is the primary reason that give us around 11% yield. So in terms of our distribution history, this fund has been consistently paying around 1.5% every quarter. So therefore, annualized around 6%. As of the June, we have a big capital distribution, total 6%, and that's basically coming from all the realized trading gain that we have made through COVID-19, as well as the realized profit that from the settle of the FX contract. So with that, let me just stop here and I'll pass it back on to Jonathan. And yeah, Jonathan, back to you.
Thanks, Gordon. Thanks for the update. Just going to take back control of the screen. Myself, here we go. Okay. So thanks, Gordon, for that update. Fantastic in-depth, as always, around the challenges of very low rates, as well as effectively the markets that we're participating in aren't being artificially inflated by central banks, which gives confidence to investors around investing in the regions that we are in. Now, just a bit of housekeeping as well. You will see a questions box in your panels. There have been a couple of questions that have come in, which we'll address in a minute when I ask Gordon and Frank to return back to the screen. You can ask your questions there. We will cover off as many as possible this afternoon. There was a question that was posted that asked whether or not the slides will be sent out post-session. Yes, we will. So that's all good. Yeah, so there's the housekeeping part of it to remind everyone to ask questions if you have any. I just want to spend 10 minutes before I bring Gordon and Frank back to talk about sort of portfolio construction. This is putting the advisor's hat on that I have to sort of look through what are the challenges and what sort of things you need to be thinking about. And I do note that there are a number of researchers on the call today, on the webinar today, and these are sort of the questions that you should be asking yourselves as well. The ultimate key question, this is more of the advisor one, is in reality, how do I generate justifiable returns to my clients? We see ongoing fee pressures overall. As our own advisory practice, we aren't too big of an issue in terms of what the level of fee is. It is the net fee return that is ultimately most important to investors, and has that been generated over a consistent period of time. There are sort of two questions I'm posing here, two for equities and two for fixed income. Firstly, can Asia and China outperform during a crisis? And then this ongoing question mark of a value versus growth. Okay? And is it something that we should be blending? Is it a binary decision of whether we should go either end? And with regards to fixed income, the question is, what's the definition of safe now, given the fact you've got artificial central bank money going into corporate debt markets, junk bond markets, when the risk-free rate is effectively zero? And second of all is, as it stands now, for the fixed income portfolio for your clients, do you require or have you considered a different approach given the rather unconventional environment that we're sitting in? So let's sort of tackle that one at a time. So what has been a stark showcase point during this crisis is that both China and Asia have actually been standout performers during this crisis. Now, this is sort of reflecting the fact that, you know, China and I guess broader Asia is sort of first in, first out of this crisis, something that both Gordon and Frank had discussed in their presentations. But our funds as well has also been traveling on a very, very strong path. When you compare that and overlay that against the Asian index, which has outperformed the S&P 500 as well as the SX 200, we are very confident of the level of sustainable performance that we've generated over this period. The other point to note as well is that the Premium Asia Fund is a fully unhedged fund currency. And over the last, as we've seen since the crisis sort of has unfolded, the Aussie dollar to US dollar has gone from sort of 55 cents all the way through to now sort of sitting around that 71 to 72 mark. And that has hurt us all the way through. So what can be seen here and derived from here is that our sort of stock selection process and portfolio construction and our risk management via our stock selection has been superior. And for the first time, Asia has outperformed in a crisis. And so that's sort of, you know, a lot of the conversations we've had with advisors and researchers that there's been a big question mark as to why has that been the case. But hopefully today that has given you some idea. Then the second question that I posed was value versus growth. As an advisor, you're now sitting here, if you have been a value or a deep value believer for an extended period of time, your faith is certainly being tested. If we then sort of subset this into our Asia ex Japan strategy, and we overlay that with the index as well as then splitting that index into growth and value, we have outperformed every single one. But what is also interesting to note is that Asia has gone through that same sort of tilt between value and growth since about 2015. So, you know, when you talk about developed markets, it's sort of the last 5 years where growth has really shined versus value. Then you sort of think back in terms of investment philosophy and think, okay, value is going to win out over the, you know, extraordinary long term. And that's sort of any 30, 40-year period. You look at consistent performance, value does outperform. Buffett, as we all know, is a value investor. From our perspective, if we can be relative value through the way we construct a portfolio, we can still take advantage of the overall macroeconomic environment, which is rates being very, very low. And with rates being very, very low, it is conducive to growth managers performing. Okay? So how long that lasts, that's a crystal ball, no one really knows, but we are in an environment where it is challenging to, or it's very, very constrained to be able to actually increase rates at this point in the cycle. So when we actually put our data into Morningstar Direct, what it has actually subsequently outputted is to look at our style. So, you know, everyone has historically thought of us as, okay, we're value partners. So therefore, you know, we're going to be value. Yes, we're value. And we're value because we believe we can exploit the inefficiencies in the market that we are operating in. When we actually run through our stocks into the system, and these are for holdings ending June, you can see that for our flagship China fund, in terms of where the style actually lands, we are a blend. Okay, we're in the upper end of the blend going to sort of core growth, which is where that fund centroid sits. And that's a fact of the matter that we are sort of, at the moment, we are in that sort of ultra large cap top end of the market because that's where we see the value, okay? Because we're pricing sort of companies for Ps that are 3 to 5 years in time, and based on the forecasted earnings, based on an economy where we can foreseeably forecast with more accuracy around future earnings, you know, those tech holdings, those Ps compress right down when we look at what their forecasted earnings are going to be. If you then look at our Asia fund, it starts to move slightly to the left of that and also slightly down, which reflects that we're going slightly lower on the market cap scale, and we're also moving slightly to the left towards more value. But as you can see, the fund centroid is still sitting smack bang in the middle of blend. So, you know, we don't call ourselves style neutral, we call ourselves relative value, with value being the fact that because we can exploit inefficiencies in the market, we have a higher depth of research into the region, we can find undervalued stocks on that basis. But it certainly doesn't preclude us from including growthy type names in the portfolio where we believe they are at a relative value valuation, where years down the track, there's going to be the P expansion, or that P comes right back because the earnings are simply so strong. This is the other chart that I've always put up when I talk about fixed income every year. And this is the navel gazing exercise. And the navel gazing exercise effectively is looking at all the different asset classes that we invest in as advisors. And then I strip out an advisor fee of 88 basis points, as well as a platform fee of about 25 basis points. So these are all index, okay? With what you see in that sort of red portion is things that effectively are generating little to no income now, okay? Things that are generating below what term deposits can offer. And the fact of the matter is that the way that our portfolio is constructed is incredibly difficult to generate what we call justifiable yield. Okay? And that's where we believe we can actually have a space in your portfolio by diversifying us out. And the diversification also drives some other benefits, which I'll talk about in a minute. So this is reiterating sort of Gordon's chart, which I won't go into in depth, but the way and the speed at which that sub-zero level of debt, or even debt that is sitting between 0 and 1%, is extraordinary. And effectively anything sort of only above that orange portion is the portion that you can participate in, where you're going to then be able to come back to your clients and justify to them, this is the sort of, you know, I can derive a justifiable income stream for you without taking on excessive levels of risk. And that's just a distribution track record again. So with regards to our fixed income fund, a lot of people have either misdiagnosed us or don't really understand how we play in a fixed income portfolio, because some people take us at extremely high risk. We're going to show you some figures in a minute. That's actually not the case. So pulling that same data out of Morningstar Direct, Morningstar is benchmarking us against the Barclays Global High Yield Index. And as you can see here, year to date, 1, 3, and 5 years, where we sit is in that blue dot part, which we're very, very proud of our performance. So we are sitting in that upper echelon, obviously, as we, you know, are slightly higher in terms of that effectively ignoring credit ratings, because we don't think they actually offer any ultimate value for investors. But where we sit in terms of that fixed income spectrum is that we are outperforming our peers and we're outperforming our benchmarks by quite a fair way. And to just then look at the next part of that and consider risk return, this is where we sort of sit as well against the benchmark. So upside and downside capture is something that researchers do spend a lot of time on looking at, whether or not, you know, you are true to value or true to label in terms of your style. So our upside capture is over 80, which means that over 80% of the time we will outperform the benchmark when markets are going up. And then on the downside, we will only underperform the market less than 40% of the time. So that's downside capture. So you want your downside capture to be as low as possible. You want your upside capture to be as high as possible, okay? And so what we've proven over our sort of 9.5-year track record is that we have consistently provided that level of outperformance to investors. And then so the final question that we ask is, okay, so do we blend well? Do we blend well with the with other strategies that are being used in the market? And what you can see here is that these are what we believe to be our largest competitors in the market. And this is a mixture of credit funds, fixed income or just investment grade bond funds, index bonds via ETFs, as well as some hybrid funds, which is the mixture of investment grade and high yield in a portfolio. And what you can see here is when you blend them against us, the correlation is not overly high compared to some of the other strategies that you see in the chart here. And so that's sort of what we bring to the table for you. We bring you a diversified fixed income strategy that allows you to generate a 6% consistent income stream, which we have never fallen less than over the history of the fund. and we're generating with fairly low levels of volatility with some levels of capital upside. So if you look at, averaging out that performance track record up until the end of June at 9.6%, that's effectively a 6% distribution with 3+% of capital growth also thrown into the mix there, and that's all net of fees. So with that, I'd like to ask Gordon and Frank to come back on, to turn back on your webcam. Thanks, guys. Okay, and I think you've unmuted yourself. Yes, okay. So let's jump into Q&A. And I'm going to stop showing my screen here so that people can see full screen video. Okay, so let's kick off with a couple of questions. First off, to Frank. The economic data being reported by China has been very strong recently. And the question is, can it be believed, or is there a better source?
Yeah, sure. I think this is a lot. A lot of the investors are asking these questions. Whether we're looking at macro data coming out from the government. I think a lot of the data is coming out from the governments are pretty much on the macro level, and we're bottom-up stock picker, so we rely a lot of channel checks data. We rely on a lot of the data mining work that we have done on the ground to rectify or to kind of see what are exactly happening on the companies that we research. I think from a source perspective, there has been a lot of ways to mine these data, including you reach out to the firm, you talk to the management, but also at the same time you can verify these data by subscribing into different third-party data provider, and which are generally considered as big data provider in the last couple of years of time. I think there are actually it is an increasing trend that we're seeing more data provider available in the market. But I think at the end of the day, it's still how depending on how our analysts or our portfolio managers are interpreting these raw data and put it into a meaningful investment decisions. So from our bottom-up perspective, data provider and reaching out to companies are the core sources. But I think on the macro level, usually it will be a good indicator, not talking about how good or bad the economy is, but also giving you indications on what are the potential response by policymaker in China. So as in the last 1 to 2 months time, we are seeing a little bit of a contracted kind of like credit growth number in China, because obviously China has been on track on the recovery path, and some of the data has been better than originally expected. So I think that would give a pretty some kind of like indications on what would the government do next, likely maybe to kind of tighten up a bit on the liquidity, but not really sacrificing the growth of the economy. So there has been a bit of a hints here and there, but I think definitely on the bottom up level, we are really doing on the ground channel checks work, just to make sure the numbers we're tracking are really something that we trust and believe.
Fantastic. Thanks, Frank. Gordon, one of the questions is, I mean, everyone's always been skeptical about the yields that we generate, right? And it's something that you and I have had many conversations about for over 9 years, okay? How is it that the market overall offers such high yields, and we sort of take advantage of those very, very attractive yields? Does it have something to do with the fact that the underlying risk-free rate in China is so low? Is higher than the developed world, and that's why property developers or other industrial companies we invest in are also offering significantly high levels of cash yield?
I think obviously the yield onshore will play a role in setting the overall yield of the bond. But I think a lot of the time when these companies come to the bond market to raise debt, arguably speaking, they are not not all the guys in the market, they're actually familiar with it. And therefore, when you, just by common knowledge, when you are not familiar with something, you obviously are more skeptical, and therefore investor will ask for a higher sort of internal rate of return in order to take that risk. But and that is something that we think that we have a key advantage of, because we do our homework and we look at very rigorously for all the issues that in our portfolio. And oftentimes we can buy good credits, at least in our view, good credit in a more attractive valuation, because the rest of the market, they are skeptical, or they just want to benchmark a certain name to a peers that we don't think is comparable. So there are a lot of this sort of moving part that will determine that, especially for new issuer, the yield are always higher, simply because of the unfamiliarity by the majority of the investors.
Fantastic. Back to you, Frank. What are the implications of Chinese tech stocks departing their US listings to return to Hong Kong and China?
Oh, yeah, this is a big topic, and I think it hasn't been confirmed as of now. But if you're a tech company and you're seeing the U.S. has been saying that could be, a list of the restrictions, including, the status to be listed in the U.S. market. If you're the manager or the chairman or the management of these companies, you would definitely be looking on the backup plan. So relisting in Hong Kong or even in China is definitely, the way out. I think some of the companies already did it. So Alibaba, they have a second listing in Hong Kong, JD.com. And if you're also looking at, the kind of the restrictions getting, the tensions getting a little bit intensified lately, that TikTok, originally was banned, and now you realize, Microsoft could, really, could have an agreement to buy out, these companies. So there has been a lot of kind of like risk management kind of like questions that the management has to deal with, on Chinese tech companies. I think this will become the trend, that's for sure. And I think this is something that the management has to do, and has to have these kind of like alternative options, just in case the tension has, escalate to that level, that you don't want to have, no backup plan when you get, when you're facing, potential delisting. But I think in terms of like capital raising, I'm not, that worried about, companies, being listed in Hong Kong will face, certain level of, fundraising pressure, because obviously Hong Kong is still a very open market, and in terms of number of IPOs, in terms of, the capital from the global, I think this is still, looking very strong. So I think that relisting in Hong Kong is just, I would probably say a part of the risk management plan by the management for the tech companies.
Fantastic. Gordon, one of the levers that you use to manage the fund is the AUD-USD relationship. Over in Australia, all of us are very aware of the fluctuations in the currency. We always look to, whether it be because we go on holiday, clearly not for the foreseeable future, but it obviously has a material impact on investments. What's the level of hedge that you're currently running over our portfolio, and sort of what's your view at the moment between the relationship between AUD and USD?
Yeah, so as you understand now, I have been using the relationship of the US dollar versus the Australian dollar as a hedge of the underlying position of a portfolio. So it has worked really quite well, because as you may understand that the Australian economy, and therefore its currency, they have a high correlation with the economy in Asia, in particular China. Okay, China buy a lot of goods and services from Australia, so therefore there's a high connection and high level of correlation between the two markets. So and we have been taking a very active strategy in managing that currency overlay. Okay, so for example, back in March, we lowered it all the way down to I think around 10% of the portfolio, so basically leaving the majority of the portfolio unhedged into USD. So usually when panic hit, US dollar will strengthen, and therefore we have a substantial gain on just taking unhedged currency risk into the portfolio. But right now, after March, as you observe, the Australian dollar strengthened from 50 cents all the way now over 70 cents, so right now 71 cents to the dollar. We actually increased the hedge all the way from 10-50% back in March, all the way up to around 85 to 90% today. Okay, so when we settle our June contract, we settle around 68 cents. So we initiate another hedge at 68 cents right now, mark to market at 71. So there's some more additional gain. So in terms of Australian dollar, the recent strength, I think that the recent strength in the Aussie dollar is not really Australia dollar by itself. It's mainly because of the general weakness of the dollar. I mentioned to you before, I was looking at 70 cents at some point and take some chips off from the hedges. But right now, because of the strength of the US dollar was actually consistently to be on the weak side, so I basically leave cash untouched right now. So we are capturing the 71 cents. But hopefully, we will see some reversal coming back. For the Australian dollar, I still maintain my view that 70 cents to the dollar is probably the max it can achieve. In the context of nothing has really excessively good in Australia or nothing has to be excessively good or bad in US.
I remember that because of the way that you've actively managed the currency really well, the actual underlying volatility of our fund is actually lower than your flagship fund.
Correct.
Yeah. That's right. So even if you look at sort of March, and that's why I posed the question earlier, the fund dropped 7.3%, and this is effectively was 100% high yield at that time. When you compare that against some of the hybrid funds or even some of the investment grade funds, they fell more than that during the month because the underlying market movements was far higher than 7%. But the AUD cushioned us.
Absolutely, and also I think investor needs to understand that when they buy investment grade bond, obviously they think, oh, it's principal protection, they have less chance to go default. But one risk that investor usually forget to consider is that mark to market. What we observed back in March is even though for the highest quality U.S. investment grade corporate bond, it fell like very, very bad, right, at that time. They could be credit safe. Those are safe credit. You probably won't think this company will go default. But on the mark-to-market basis, because of the liquidity in the market, those bonds actually in that round, I think some of these IG bond funds they have a double-digit mark-to-market loss in just one single month. So I think investors need to consider both credit risk as well as how it will perform over a long term in terms of mark to market. On a normal market condition, obviously those will be okay, but investor has largely overlooked that kind of impact on mark to market to your portfolio.
Yeah. So two sort of final questions for Frank. And this is an interesting one. To what extent do you think growth in China as well as Southeast Asia is linked to consumers in the USA? So I guess the potential proposition here is that China and Southeast Asia's growth is driven by developed markets. Is that true?
Okay. Well, obviously, if you look at the absolute amount, the number that of goods and services being exported to the developed markets is huge. But if you could also look at from a different angle, just simply looking at the China GDP breakdown, over 90% of the contribution to GDP are coming from domestic consumption, which takes up about 60%, and the remaining is domestic investment, which takes up about 20 to 30%. Net export throughout these years are actually not being a big part of the growth contributions. Some Southeast Asia countries may see a little bit more because some of them are actually, commodities and natural resources exporters, such as Malaysia, and also, India market. They have like a lot of like services export to the developed markets. I think it's let's take China as a reference, it's the growth drivers are very obviously coming from the domestic economy, and largely that was coming from consumption. So that's why I think a lot of the uh, focus or investment thesis would fall into how the domestic economy are driving the company's growth. All these years, we do see some of the good companies that have leading positions in export kind of areas, but we're just being very selective. As we have mentioned earlier, the Premium China Fund, we have led in information technology exposures in Premium China Fund versus the Premium Asia Fund is simply because we're actually more, kind of cautious about how the policy is going to play out between, China with the rest of the Asia countries as well as with the US. So, but just going back to your question is, I think there has been a lot of linkage and more, dependence on the domestic consumption in Asia countries, particularly in China.
Fantastic. Now, the final question is, and it's two people asking similar questions, so I'll just loop it into one. What do you think the suggested flight of capital out of Hong Kong due to concerns about increased capital constraints introduced by the CCP or the Chinese Communist Party will have on investor confidence and risk to returns? And do you believe the current issues in Hong Kong will have a negative long-term impact on the Premium China Fund, and I guess as an extension to the Premium Asia Fund as well?
Okay, maybe I'll just maybe Gordon could add on later with regards to this thing. I think yes, there has been a lot of noise, as I mentioned earlier, that the global or the U.S. Has been putting pressures not only in China but also extending, some potential restrictions to Hong Kong, and it would be, I think it will last for a little longer, prior to the presidential elections, and it also largely depends on how or who would be the next president in the United States. I think. Currently, it's just an inevitable kind of like situations or conditions that not only U.S. but U.S. will ally with other countries around the world just to give a little bit more pressures on China, and lately more focus on Hong Kong because of the launch of the Hong Kong security law. I think just going back to if we take a step back and see what are the unique positions that Hong Kong has been playing over all these decades. It has been a key financial hub and also a financial kind of bridge that connects mainland China and to the rest of the world. And there has been a lot of good foundations that's being built, on an institutional basis, and also even like the currency peg system that gives a Hong Kong a very strong or unique status that will continue to be, a very crucial city as part of, China's agenda to open up their domestic economy to the world. So from that perspective, I think China's intention on Hong Kong will, I think that I would say the benefits or the interest in Hong Kong will remain very clear and solid, that it will maintain as a very, I'll probably say, a solid financial hub just to get connected to the rest of the world. So in terms of the flow, in terms of how the capital is being restricted, I think it's never China's interest to make it stricter or to limit certain or to shut down the doors, because eventually that will hurt the progress of the domestic economy opening in China. While what the foreign countries are doing to Hong Kong, I think currently we're not seeing a very real kind of like impacts. It's mainly about tariffs, sanctions on government officials, or maybe losing some special status, which we haven't really touched on really restricting, vividly in the financial system. And I think this is probably the last thing they want to touch on, because it's not only about one-sided kind of like damages. Obviously, a lot of the corporates, a lot of the financial institutions, they have been long setting their regional headquarters in Hong Kong. It's not kind of like a one-way kind of decision or one-way victims that will suffer from all these potential restrictions, but also everyone is mutually kind of like connected, and I think that will be a lot of like price to pay, and I personally think that will be continue of seeing some noises on this level. The restrictions definitely, I think China will continue to be really supportive to maintain Hong Kong as the key financial hub. But to the rest of the world, I think there are a lot of complicated considerations before they actually do investment restrictions on Hong Kong market. So that's my view, and just bear in mind that will be a continued headline news. But from what I have seen from the past couple months of time, it actually carries a lot more symbolic kind of service kind of impacts on noises rather than having a material kind of impacts. I'm not sure if Gordon wants to add on, but that's my views on this.
For me, I agree all of the points that Frant just mentioned. I think the key is to know that China is committed to continue to open up the economy. They want to be part of the global citizen in the world market, right? And they don't want to go back to 50 years ago when it is still a closed economy. So the trend of opening up will continue. That's number one. And number two is Hong Kong has experienced multiple sort of crisis mode in the past, in the history of this place, and we have survived. And also, I think ultimately, business chase business opportunity. They chase money. They go where the money is. And if you look at globally, China is by far the biggest consumer market in the whole world. Okay, they are both buyer or sellers of a lot of things. Okay, so I think in the short term, as Frank mentioned, obviously there will be some impact, whether it's sentimental wise or economics wise. But I think after a reasonable amount of time, people will get used to it. The business leader will know that there's a national security law on the back. But I think they will just have to live with this fact and continue to do business. And for the government, I think now they obviously want the country and Hong Kong to do more business with outside world. And I think that the key for that national security law is to basically grab their hands around some of the more political sensitive issue around the city, because Hong Kong has arguably been in many people's eye too open politically. That might sometimes cause a national security issue. So they just want to close that whole loop, and basically and actually after the introduction of the law, public demonstration has vanished, and people can come to work and go to places during the weekend. So in a way, it introduced back some kind of harmony back to the society, and people can go on to live their life and do the work. So I guess just to sum, the key is, okay, China will continue to open up. Business worldwide will continue to do business with China and also Hong Kong, regardless of whether there is a national security on the back. They will forever remember it. And therefore, they have to remember this law is not applied to everybody in the business world and also in the society. It's only targeted to a specific group of separatists who they advocate for independence of Hong Kong, or they want to overthrow the government in China. Those are the target group they want to handle. For the normal guy like us, normal businessmen, we just want to do trade. We just want to make money, right? So from that perspective, I think short term, yes, fundamentally there will be some impact, but I think after a medium term, people will just get used to it and continue to do the business with Hong Kong and China.
Gordon, there was just as you were speaking, there was sort of a linked question there with regards to capital outflows. So would there be any ramifications, or what are the ramifications for the income fund if the Hong Kong dollar peg to the USD was removed and it was transferred to a peg with the RMB? I mean, I guess the question is there a risk of that? Is there a material risk of that happening? And if so, what would you think would happen?
Primary impact is no, because as you can see, because all these bonds are US dollar denomination. Okay, so I'm not buying Hong Kong dollar denominated bond and translate to US dollar and then back to Australia. We don't do that. Every holding in our bond position are US dollar. So therefore, the peg of the Hong Kong dollar will have the primary impact is zero. However, the impacts, if I could imagine, it will mostly on sentimental wise, meaning a weakening of the Hong Kong dollar. It may impact the risk appetite of, in general, China Hong Kong issue, and therefore it will reflect in a lower bond price. But if you just talk about the currency impact, it's zero. But the secondary impact through sentiment, there could be some repricing at that point. But again, as I see, if people hold a more sort of medium-term view, those could be a non-event to especially US dollar investor and also to the investor down in Australia.
Sorry, Jonathan, just going back to the earlier questions that you have, I forgot to answer. What are the implications to Premium China Fund or maybe Premium Asia funds under all this like political, backdrop? I'll just like to re-emphasize one thing is we have always been treating, the changing of, the political environment as a risk to the company that we invest. So that's why I think since the Sino-Trade discussion that happened in April 2018, we have been putting tremendous efforts on how the relationship has changed the whole landscape and how the individual corporates are being affected. At the beginning it was more tariffs, and later it was investment potential investment restrictions, as well as different technology supply chains kind of like restrictions. We're actually very careful on on all these potential risk factor, but I think after all these months of the developments and also the studies, we realize one thing is it's always coming back to our core philosophy, in a sense that what are the outcome of all these incidents and what are the opportunity and risk? Because we're just, I think first of all, it's just not, we're not kind of like shy away from seeing all these things. We're actually seeing every single time when things happen, it's a reshuffling of the potential winners and losers in the market. So I think the key kind of strategy or the key strength as a manager of managing assets is being able to identify who are the latest winners and who are the latest losers, and you're avoiding the losers and you're getting into the winners. And I think this is actually especially something that we have done in the Premium China Fund versus Premium Asia Fund, as the information technology weighting, as in I've been saying technology supply, 5G related, they're very kind of robust, seeing a very solid growth. But we have a very different positioning in both funds, because a lot of the 5G related upstream supplier in the technology space are very positive to Taiwanese and South Korean names, whereas in China, because there has been a lot of technology restrictions, that we're turning a little bit more skeptical. So that's why we have a much lower exposures in information technology. So it's sometimes like these kind of events create certain level of opportunity and risk. I think it's just really being down to the team and the investment colleagues on how we're assessing these outcomes. I think going back Hong Kong, maybe capital flow, who are the who would benefit and who would suffer. These are something that we will continue to assess. I don't think this is say Premium China Fund or maybe China market will no longer be the destinations of investors' money, as Gordon mentioned. global flow, market will continue to open. It's just being, the overall view that we remain closely monitor on how the situation has changed and how we're picking the winner of this market. So this is something that I would like to add on to the portfolio implications.
I mean, ultimately, the summary of that is, we need to be adaptable. And when you're operating a market in Asia, whether it be fixed income or equities, you have to ensure that you're adaptable. Active management is definitely the way to go. The market inefficiency drives our stock picks, our bond picks, and therefore that's how we add value to your investors' portfolios. So we'll wrap it up there, everybody. Thank you for your time, Gordon, Frank. Thank you very much for spending 2 hours with us now. For those of you that are on the call as attendees, thank you very much for listening and watching. Slides will be sent out to you. Please fill in the feedback forms that we send out to you, because we will be running more of these events. And I wish everyone a good afternoon. Thank you.
Thank you, everyone.
Thank you.